This is episode 4 of Systematic Shenanigans. It is hosted by myself, Manir, also known as Ghostal Trades on Twitter, and Pedma, another algorithmic and systematic trader. We are two traders that have been trading for over 5+ years, both in varying markets. Pedma mainly focuses on crypto, while my main attention has traditionally been on futures and equities. We record these episodes every single Monday to give you an authentic look into how trading life can be and the topics we're thinking about each week. For this particular episode, we cover a couple of different topics, such as if AI can actually help you in trading, whether indicators need to be well known to actually be effective, and a couple of our favorite books/learning resources over the years that we've come across. With that being said, let's get straight into this episode.
So the first topic is how can AI help in trading, right? That's a big topic nowadays. You see all of these posts and people talking about AI for trading, AI for this. And I've had some practical experience with this in terms of what I've used AI for in trading, not directly to trade. And I think it's an interesting topic because I don't think that AI will replace humans in the markets. I think our markets are too complex, too dynamic, always changing, new information all the time. Maybe my understanding of AI is too limited, and I don't understand how it could abstract enough to get all of those nuances. And even if AI can really do some more like broad factor models or factor exposures and trades like that, I still believe there's an opportunity for always an opportunity for smaller players to go to markets where it's not cost effective to deploy such models there. So smaller markets, stuff like that. But in terms of using AI to trading, for example, last few weeks I've been trading on chain on decentralized exchanges, and I've been exploiting these funding rates on these exchanges. And one of the things that I used AI was to build an entire tool from scratch, like an entire dashboard with all these fundings that I can capture and put everything together in one place. Now I just every morning open my dashboard and have all the information centered there. What would have taken probably weeks before to develop, maybe even a month or more to develop, I built in a few hours. So that's how I see AI helping in trading. What do you think?
I guess I'll split that then into your kind of two topics of it. Like the first one around if AI will kind of destroy markets or mean like they're super efficient, right? Like that's your first topic. And the second one is like if it'll help you with like your own personal trading, like, creating dashboards or things like that, right?
Yeah, exactly.
Okay, on the first one, I will pretend this. I've thought about this question a decent amount, and I've just always come to the conclusion that I'm not smart enough really to know realistically what would happen. I think to some extent there will always be edges and alphas to exploit. I find it kind of hard to believe that there will never be anything to exploit, right? Because end of day, it's uncertainty. So unless there is a model out there that will be 100% predictive, I don't really see how it would work. Even with working with AI almost every day, because I work with Ask Edgar, I don't see a time where that would potentially happen. Or if it does, then we are in a completely different kind of world. We probably have completely different ways of making money and things like that. So it'll be a very different kind of conversation. For the second one, I do agree. I think you can use AI a lot to help with speed of development. I would still say there's like a foundation level that you kind of need to know in coding, or you need to understand it at least specifically for trading. Because as you probably all know, like if you ask a AI to code you a backtester or something like that, there will be a lot of flaws traditionally within it because it's not thinking about everything that goes into trading. So a really easy one, right, is like if you ask it to make a shorting crypto backtest, it probably won't include funding rate unless you specify to include it. So if you know all that kind of background knowledge and you make it a really good prompt and you optimize that prompt and debug it and things like that, then I think you can do amazing jobs. It's kind of like what you've been doing, right? And I guess I've been using it as well. So for speed of development, 100%, you can probably like 2x, probably 10x your kind of speed of developing things. For strategies, what do you think? And then I can kind of give you my opinion.
Yeah, exactly. It's like people talk about AI in trading, and that's the way I see AI in trading. AI is there to help you make your trading more efficient, right? You need something developed, you can develop it quite fast. But it's like you said, if you are going to be doing stuff that is more complicated, like testing a small caps strategy, you can just ask the AI to build you that. Maybe you can, but you really need to dig into it, like into the code and everything, to make sure everything is looking good. So you need some coding basis. So that's the way I see AI in trading, is really to make your work more efficient as a researcher, as a developer, and in turn make you a more efficient trader. And the other side, in regards to the trading with AI, I really don't. It's like you said, I'm not smart enough to be. I don't have all the context of what AI can do, but it's really hard to me to think of a future where, in a place where you have so many like statistical relationships that are meaningless and you really need context. It's not just like looking at data and getting an analysis on it. You have to give context to why that effect happens, stuff like that we talk about a lot. And I don't think that AI, I think it will be very hard to code something like that to trade on its own, or to be more accurate in their forecasts, let's say, just because you used AI. And if you can code that, maybe you should already be doing it yourself. You're not, the AI is not discovering anything for you. It's just telling you what you already know. So
Yeah, I would agree. Like, I think this one will probably agree quite a lot on, but like, what do you think about all the ChatGPT strategy AI videos that are on YouTube, around like trading? What's your kind of opinion?
I have the tendency to not trust any backtests, and very much, especially generated by any AI.
Yeah. I think AI is more of a tool than like a saving grace or something. Like I've seen
Definitely.
some people try and ask AI to create a trading strategy that then it would trade. And, like maybe it could work if you're giving it really good boundaries and it's like something very simplistic, maybe. But for the most part, it there isn't enough context there. I think for the most part, I think to actually make it effective, and especially I think a lot of people miss the part that like while I won't like disagree in any way that obviously AI and machine learning has moved so much recently and it is very much more beneficial nowadays, hedge funds and things like this have been using machine learning for ages. I feel like if there was an AI that was just ultimate predictive and was the best strategy ever, people would be using it already. You'd probably see it. While there's definitely, I think, HFT improvements, at least from what I've heard. I don't think it's a time where you just plug in an AI and let Claude trade for you on any market. I still think you're going to need some sort of experience yourself to actually build out those sort of models.
And if you're going to do that, you have to be really specific, like tell you what it is trading and why should it trade it, and give it all the specificities like of that trade. And if you're already doing that, you already have a system that makes money, right? So it's not the AI really making money, it's just managing it for you or whatever you built it for. Now, in terms of finding alpha, I really don't think so. Yeah, it's like you said, machine learning has already been used for a long time. It's not a new thing, and AI is different, of course, but it's more of the same. You are just looking at the past, and the past is always changing.
I also think all the fundamental problems with AI have still stuck around. Like, or I guess with machine learning, it's like overfitting, data mining. All of those issues still persist. At least to my knowledge, no one's like found a rocket-proof solution to those. There are obviously robustness checks and things like that, but that's what's pushed people away, at least extensively using machine learning and things like that, because you run into those issues so easily. Especially when if you think about how AI is trained, it doesn't the only main solution it really comes down to is overfitting. Like that's kind of how that works for the most part. And there's obviously lots of different ways to make it more generalized, but in trading that becomes a very difficult problem to solve. And most of the time that problem is harder to solve than to do, basic portfolio management, create a selection of strategies that do trend following, mean reversion, etc. That's often a lot easier way to get returns than trying to solve the very difficult problem of overfitting.
Exactly. And if you are doing that as an individual trader or at-home trader, whatever, you you are basically spending all your time trying to develop that tool that I'm really skeptical about. When another guy just running a trend model in crypto or in equities or whatever, and finding some weird edge there is just making money every month, and you are like chasing rabbits. It's like you're not going to get it. So.
Yeah, 100%. Well, at least for my next topic that I want to touch upon, I actually saw this. I think someone replied either to one of my tweets or something around it. Maybe I just saw it on Twitter. But he said, do you think an indicator needs to be well known to have an impact? So basically, what he's trying to say is like much of an indicator's value is from how widely known it is, and it becomes a self fulfilling prophecy. I had really mixed thoughts on this, but I kind of wanted to hear your opinion first, and I can kind of add on to it.
There's so many things in that sentence there.
I
It's
know.
like much of an indicator value is in how widely it is used. It's becomes a self-fulfilling prophecy. An indicator is just it just like looking at price and summarizing it in some fashion. That's basically what it is. Sure, if everyone piles into an indicator, then that will cause market impact, and so maybe it changes the dynamic of price after the signal, right? But if everyone is piling into your signal, and if your effect that you are trying to exploit is not that large or doesn't have that much capacity, then everyone is taking a portion of your returns, right? So I don't understand. It's like it becomes a self-fulfilling prophecy. In what? Does it go somewhere? Does it change? Does the price dynamic change after that? It's short-term, long-term. There's a bunch of assumptions there. But yes, I would say that if everyone piles in onto the same indicator, that will cause market impact, and by itself, that changes market dynamic around that indicator.
I have a similar opinion. I think it's just a bit more nuanced. I feel like the fundamental thing he's saying is correct, that if an indicator is widely known, then it's going to be a bit more of a self-fulfilling prophecy, meaning there'll be some sort of reaction to that particular indicator, right? I think that is correct, but the part I don't agree with as much is that much of an indicator's value comes from that. I feel like you can have many indicators, as you've already said, like an indicator, end of day, is just a formula. It's not some magical thing. It's just a formula of representing price in a different way. So you can have custom indicators that are meant for you that provide a lot of value to your own trading or your own system that don't need to be widely known to actually provide value or returns to your actual system. Like there's custom indicators I've made for detecting choppy like market ranges, right? Is it a widely known indicator? Well, I don't think so because I custom made it. Well, obviously it's based on general principles. It doesn't necessarily have tons of people pile in because of it's custom made by me, but it still provides much value to my strategies because it helps me filter out trades. So it's a two in one. It's sort of correct, but I don't agree that it's all the indicators value just comes from people knowing it.
Yeah, and also it's like it all depends on the objective, right? If the objective is to forecast future returns, which is the objective of every signal, you get the signal in the market, you want it to forecast some sort of return, and that return to be economically viable after costs. And if that indicator forecasts returns for whatever reason, then you have there a trade. I don't understand just the self-fulfilling prophecy part of it. What prophecy? Does it make you money because there's still a ton of things that you have to deal with after the signal. You have to exit a position, stop losses if you use them. Where are you going to exit? Is it long-term, short-term? And whatever is going to dictate that is not the indicator, in my opinion. The indicator just tells you need to get into the market because there's a better than zero likelihood that the effect that you want to be exposed to will occur. That's basically what you want in an indicator. The indicator doesn't, and you use that indicator to forecast some type of behavior in the market. And yeah, it's just, I think this is just retail conversation here around like, yeah, that's it.
Yeah, no, that's fair. I agree. But like, there's just so many people still at that stage, and like, I think we both forget how many newer traders there's gonna be always then more experienced, right? Like us trading for five, well, you obviously 7 years and me for five. We're a very small percentage, so there's always gonna be way more people saying more of the retail takes. Obviously, we're still retail. I don't, we're not some institutional big brain or
Yeah.
whatever, but yeah, anyway, the next topic I did want to kind of jump on, just because I think a lot of people would probably find value from it. And I know you've been buying some more books recently, so you maybe have some new ones that you'd want to recommend. But what would be your sort of favorite books or even learning resources that either you're using now or when you were getting started, like which you actually found most value from?
Yeah, sure. Just a quick point on the last one. It's a pretty interesting conversation. It's
Sure.
like I wrote about this one time. It's like an indicator. An indicator is like um, it's just a tool to extract something from the market, to be exposed to something. An indicator is nothing. Like I know that it's like you said. There's a lot of beginner traders, and we don't think about them, at least how they think that much. And when I started, I also saw like these indicators. It was my path to making a bunch of money. The indicator is nothing. It just tells you something about something that is better than zero, that will make money, that will probably make money. It's very noisy, whatever. What you want to extract from the market is never the indicator. The indicator is irrelevant. Always think about what you're trying to extract. That's basically it.
I think that's a very good point, to be honest. I think that kind of sums up a lot of indicator use because the one thing I always like saying in trading is like everything is nuanced to some aspect. There's always, you'll see people either on two sides. People say you should never use any indicators, you shouldn't have indicators on your chart. Then you'll have the other people that are using tons of indicators, new quirky indicators, things like that. And I think normally the answer is sort of like in the middle, meaning that if there's a natural use and tool, as you're saying, for that indicator, then use it. Like that's totally fair. But you don't need to be chasing all these new indicators. Especially one of the biggest signs you ever see is like, even I sometimes fall for it, is like you'll see someone mention like this new thing you've never really heard of, but it looks sort of interesting on Twitter, and they're using some sort of custom formula, and you're like, oh shit, maybe this is the the one signal I need that's going to be really predictive. So it's, you can always face that issue even as like more experienced in trading.
Yeah, yeah, for sure. And in terms of your books, the books that you just said, how can I put this? There was a lot of books in the beginning that I would not recommend now, but that were helpful. So I would be a bit of hypocritical if I said I wouldn't, but I don't recommend them. But I would go to everyone that actually trades. Okay, that's the number one criteria. Yeah, theoretical and academics have their place, and that's perfectly fine. But go for the people actually trading, and that's like you have there Robert Carver, Ernest Chen. You have podcasts. You have people like Robert James or publicly. You have go for the people that actually trade. Okay, and I'm not going to be saying us, right, because I'm not not trying to self promote, but find people that you can confirm that they are actually trading and trading profitably. That's what you want to achieve, and consume everything that they have to offer. That's what I would do. Don't bother with the people that like are selling you other stuff that is not trading. Because if you are here to learn trading, you have to learn from people that are actually doing it. Like if you are doing fitness, it's the same thing. You are not going to learn from someone that is not fit, right? It would be counterproductive, let's say. But you are going to learn maybe from the fittest person that you can find and that sells that service. Same here. It's practical in every place. And those people that we have here on our notes are very good for that.
I agree. I think for the most part, I'll split it into two sections because I have some different thoughts. For the first one, I think, yeah, definitely look for people that are actually trading. Obviously, the one caveat I'd say to that is some people don't have to be trading currently. I know some people are different on opinion of this. It's a hard one to say yes or no to, but I would say as long as someone's traded before and has done a consistent track record, or at least just traded for a good while, they'll be able to at least tell you mistakes they made so that you can try and avoid those. So even if it's not someone even trading the exact same fashion as you, I think it's always good to keep your perspective wide. So like I don't believe I trade fully similar to Robert Carver. I think there's things that I overlapped with because I've obviously learned from his books and things like that. I definitely don't trade even similar to Ernest Chan, but both of those have provided a lot of value in my journey over the time. So for books anyway, I would say look into Robert Carver, Ernest Chan. I think Kevin Davey, I think, has some solid books. I've never read all of them, but I believe, and at least from what I've seen, they're pretty decent and they cover a lot of the fundamentals. But then the second point I wanted to say is I don't know, I might get some hate for this, but personally for me, I've learned things from people that I'm pretty sure were scammers back in the day when I was starting out, but they still introduced me to topics I never heard of before. So it's a weird caveat to that. Obviously, you can't recommend that because obviously maybe I was just lucky in a survivorship bias that when I was starting out I saw some things and that kind of led me down a path. But I would say general exposure to most parts of trading is always beneficial. That's why like I'm always a fan of like going on Twitter, looking through different accounts and things like that because end of day you need to be exposed to a lot because when you're getting started to trading you have so much ignorance. There are so many things you do not know, and even now like I do not know much about options at all, or like things like that. And even dealing with crypto, obviously I had beneficial from you, but there were so many things I wasn't aware of. So you have to have that general exposure as well.
No, I definitely wouldn't say that only to learn people that trade the same style as you. Definitely, I didn't mean that.
Yeah.
I mean people trading in general. I'm always reading. I read from everybody. People trading large caps, people trading options, volatility. I read from everyone that is a real trader. That's what I meant. That's what I read, what I consume daily. In terms, for example, people don't like this very much because he blew up and had a tragic end. But I really love the Jesse Livermore book.
Oh yeah,
Um,
same.
yeah, like yes, tragic ending aside, and all the blow ups that he had a very wild life. But you can see that he was a real trader. You see through the entire book him going through the process, what he was doing, the stuff that he was learning. That type of stuff you can take lessons from people that even though I mean according to what's recorded he was the richest man on earth at one point just from his trading, at least from what's public records. And so there's always lessons to learn from them, and having a book like that goes directly through all of those steps and shows what the people was doing. All of that has lessons, and yeah, learn from people actually trading, actually in the trenches. That's how we learn.
Yeah, I would agree. I would also say that's like another point around track record. Um, while yes, obviously you'd love to be learning from someone that has an amazing track record and consistently profiting, someone that's gone through the ropes of it, even if they've blown up and things like that, there's so many lessons you can learn from it. So I would never fully dismiss someone for that. I also like I think we've mentioned on other episodes that in trading you have to keep an open mind. I never try and look at someone's situation and instantly think no, I don't believe that at all or whatever. I try and keep some sort of open mind, see the nuance to it, see if there's any applicable learnings for me, and I think that's normally the most healthy way to go for it. But obviously yeah, as long as they have some sort of trading experience, then I think you'll learn a lot from it. I'd also say one last point on this is podcasts, to be honest, have helped me more than books. I think books are amazing kind of like not summaries, but like structured content. Whereas podcasts, you can sometimes hear some amazing glimpse of like, amazing gems that you just never would have seen in the book because it's just them thinking out loud and then talking about a particular topic. So I've consumed an unholy amount of podcasts over the years. And I think that can be a very valuable asset. Obviously, you can still have, information overload from it and all those sort of nuances, but I've probably learned the most from podcasts and second from books, probably.
Yeah, I actually don't listen that much to trading related podcasts. To be honest with you, maybe it's a flaw. Um, I
Did
listen to some, but I just don't listen to that much. To be honest with you.
Did you not listen to like Chat with Traders when you were starting out?
Yes, yeah, but yeah, but I did listen to it, but it was always around like the quants and systematic traders.
Ah, so you were like more selective with the episodes.
Yeah, exactly. Okay, no, that's actually not true. I listened to Flirting with Models,
Ah,
but it's
true.
yeah from but it's not the main source of content for trading in me. I like the written style more in terms of trading.
That's
If
fair.
it's business stuff, I like. There's a lot of podcasts there. I like to listen, like But in terms of trading, I don't find a lot of valuable podcasts. To be honest with you.
No, that makes sense. For my sort of last topic, it's kind of like a two in one. It was mainly around two principles that I think everyone knows, but it's kind of hard to stick to, especially if you're in your first year, then maybe you haven't been aware of these. But I think you should always focus on decision quality over outcome, and you should always focus on process over results in the short term. They're two very simple principles and two things that can easily go missed. But I was reading through recently the Thinking in Bets book. I was just having a reread of it. I wanted to also do a thread on it, so I was having a kind of skim through the whole thing, and it was just one thing that hit me again, that when you are trading, you can sometimes get very overwhelmed by singular days or singular decisions that you're trying to look over. And the magic of trading, or the actual returns part of it, is by compounding that over a lot of days, a lot of decisions and things like that. So if you can try and control your decision making, whether that be, if you're going to override a system today and controlling that urge, or it would be, how you're going to design a system and how long you're actually going to take through going through the proper steps, things like that is going to what's actually going to compound outcome. You'll never be able to, at least from my experience, I've never been able to force an outcome out of trading in any way. And every time I do, I normally force the opposite outcome for the most part. So just focusing on those two key principles, I wanted to mention them because they're a good reminder for me every week. So hopefully it's kind of like a reminder for everyone.
I think that those are great. I think those are very important. It's like every decision, every trading decision in business and everything like that, even in life, but we shouldn't optimize always for that. Of course, there's time for fun, but every decision should be like plus EV, plus expected value. It's like, imagine that you are crossing a street, right? You have like sorry, the English words fail me, but you're trying to cross the street and it's this red sign. And every time there is a red sign, you pass. You pass. Every time there is a red sign, you are taking a negative expected value decision every time that you do that, unless there's some really good thing at the other end. But every time that you do that, you are taking negative expected value. You might get away with it 100 times. Maybe you are careful, but you are taking that decision. Eventually, some mistake will happen and you'll get hurt. Same like, and all of those decisions stack up over the long term. And in the context of trading, every decision that you take, you should understand the expected value of that decision. Like you take a trade today. Why did you take the trade? If I ask you, you have to tell me, because this trade, according to my historical records or even my own trading, has this expected value every time I take it. It doesn't mean that you're going to make money every time you take it, but you know that the decision has some expected value. Like when like flipping a coin, for example, and you have like 10% advantage. If you win, you make $1.10, and if you lose, you lose $1. You have that 10% advantage. You might go 100 coin flips that you lose money. That's the nature of probabilities, but you are taking decisions with expected value on your side, and you should do that all the time.
I've never actually heard that metaphor of it, but that is so perfect when thinking about it. It is completely true. That is an amazing metaphor. I'm actually gonna have that noted down. But yeah,
Sometimes I do sometimes I come up with some good stuff.
for real, that's such an easy way to explain it, because I think like everyone can understand. If you walk across a traffic light when it's red, yes, you may survive that time, but if you did it 1,000 times, what do you think the probability of that is? And it's just such a good way of visualizing. I think that's one thing I've also learned over the years from trading, and it was probably I guess it was one of the most fun things I experienced, was when you hear a phrase or you hear a metaphor, something that you already know, but it just clicks that time because it's just so well described. And that's personally why I don't so much believe in the idea of like information overload. While obviously it is a thing, trying to consume as much information as possible until you have as many of those click moments. Because when I was starting out trading, there was so many, like, you hear all the principles. The principles take you maybe less than 30 minutes to an hour to like discover the key main principles of trading. But for them to really click and for you to understand them, and then there's a whole other section of you to actually, apply them, takes a long time. And having those sort of click moments where you understand that visualizer, it makes a huge difference.
Definitely. I always prefer as well to learn when people like tell me something very visual or from day-to-day life that you can relate to, and that stuff sticks in your mind.
Really does. All right, well, I'll let you move on to your topics. I think you've got one around like market impact, right?
Yeah. So this one is very practical. So I was quick story. I was trading. I think it was yesterday. Yes, it was yesterday. I was trading these. So there was an arbitrage opportunity on a decentralized exchange, a new decentralized exchange with a very shady centralized exchange. So there was a pricing difference in those two exchanges. But there was one problem. It's like it's because either one order book had like $100,000 that was trading in it, like for the past 24 hours, and the other was trading like 50K, like really slow amounts. But the opportunity was so large that I actually got into it, and I started poking around on the order book. I started bullying the order book on the other side and pushing price down to fill my orders on the other order book. So it was a mess. At the end, like if you backtest something like that, it makes sense that the opportunity was like 10% a month. No, sorry, not 10% a month. It was like around 20% a month non-compounded. It was huge.
Wow.
Just for holding something delta neutral, so without directional exposure. And I was like, okay, I'm going to size my way into these books. Yeah, I ended up making a mess. I had to leave the order book on a rush because I made a miscalculation on the other side. Yeah, I just made a mess on that day, and it's so important. And to me, I wanted to bring that up because when you are like making models and trying to build systems and everything like that, you don't really know your impact or if you can really extract that edge once you go to the market. Yes, maybe if you're running a trend following model on equities, maybe you'll have problems with margin overnight and stuff like that, depending on the broker. But there's so many things that happen when you actually go into the market and you try to capture whatever you're trying to capture, because every position that you take, you are impacting the market, no matter how small. No matter if you take $100, you are still causing market impact. Obviously, if you trade higher, it will affect you more. But these things are only found out when you actually go into the market and trade them, not on backtests, even though they tell you something about the past.
100%. I think it's like a very clear example of like I will always expect lower returns for the most part compared to PEDMA, because at least on futures I have amazing liquidity. I don't really have to worry about market impact. I'm not trading 10 contracts plus or something like that on a single candle. So all those sort of things mean I'm going to make less return overall because it's just more efficient. But it means I have less headaches. There's less ways I can mess up. Which then evens out, like it's around your pros and cons of what sort of strategy you want to take. So if you want something that's higher return, traditionally, not always, but traditionally you're going to have some of those more headaches, as kind of like Padma's describing.
Exactly. It's you get paid for those headaches. If you wanna, if you wanna have headaches and stress and stuff like that, there's markets that will pay you more for that, for risk. That's why do you get paid for, because there's opportunities right now that I'm capturing on my portfolio that are only available because I'm willing to go there and risk and manage capital and bridge capital across different protocols. It's a pain just to get capital there, but I'm capturing decent, very good returns just because of that, because I'm willing to cross that line that other people aren't. And I'm not like, how can I say it? I'm not trying to say that I'm better because I do that. No, it's just because maybe because I don't have the capital that others have, and I can go there just because of that. Because if I was trading $5 million, I wouldn't be going in these exchanges because this incentive would no longer be there. So it's always about what you can do and what kind of risks you are willing to take, I guess.
I would also say you are one of the most risk takers I know, at least percentage wise. you go after most opportunities, and like I'm down for most as well, but you definitely explore, I think, a lot to get those returns.
I know, but you also have a good you also have a good risk appetite. Let's say we traded some wild some wild stuff.
Yeah, no, that's true. I guess it's because like at least most of my capital is in futures, so I'm pretty chill on that. So the risk appetite is like the only other thing that's left now is like if I have spare capital, I'm gonna try and throw it at something and see if
Yeah,
we can make any returns.
but I think I read in a book somewhere. Um, I don't remember the name of the book, but I was reading it, and the person that wrote it said that trading for some people is like scratching that risk that we all humans seek. You can have a stable job and everything like very stable, but you always have that itch, that you need to scratch. And for many people, it's like gambling or something like that. But when you trade, like I trade most of my capital in systematic models, like you were saying, like but on crypto. But then I use some capital to go after these more risky opportunities because I don't know. You need to. I can't say, but you know.
I would you this is a very edgy question, but do you think you'd be like a gambler if you didn't trade? Like, have you ever gambled that much or no?
Yeah, I have gambled, but to be honest, how can I say? Because it's fun when I'm there, you know. But
Right.
I'm always annoyed at it because I'm trading without expected value. I know that I'm there to lose, so I can't justify it, you know. I don't remember the last time I gambled.
At least I think at least for me, like I don't think I'd have like a gambling addiction, but I would probably lose an unhealthy amount, like higher than average if I was like a gambler. Just because I have sometimes, either gambled online or whatever with friends, and I notice like myself sticking around for way too long. And that's why I think I was always drawn to trading anyway, because, there's at least there I can actually try and make money, and it's not guaranteed that I lose money. Obviously, while it's still very difficult, you're not going to beat the house when gambling, especially not with these online casinos and things like that. So it's just kind of my way of being more productive, I guess,
Yeah.
around it in some way. But I think all traders have to have that appetite. If you did not have that like for my girlfriend, for example, she never has the urge to place a bet of some kind. It just, I don't know. At least for her and her psyche, it doesn't happen. Like, and there's many people I know that wouldn't even take a risk on like a salary job and things like that. So I think all of us just have different kind of risk appetites, whether that be environmental or just how we're born. I guess it depends.
Even when I had a job, and this is a conversation I would guess that would go on for an hour, but even when I had a job, I remember like I was scaling in income, everything was going fine. I had a very stable job with very good benefits, stuff like that. But there was something, always I would get dissatisfied. Uh, like very quickly, yeah. And I was earning at one point well above my age for my country, and still I always felt like something was missing. And when started trading full time and doing business in trading and everything like that, I never felt that again. Never. I can't explain it, but I think it's like I don't know, we are more prone to risk. We want risk. We need that risk to feel like we are doing progress in life or something like that. But yeah, in terms of gambling, if I started playing poker, maybe I would have justified it because poker at least you can go around with probabilities.
Yeah, that's true. Same thing. Like a favorite movie of mine for a long time has always been 21. So have you ever watched that movie?
No.
It's a great movie. You need to watch it sometime.
Hmm.
It's basically around like card counting of like blackjack, and
Yeah.
it's just an awesome movie. And I remember even watching it when I was younger. Like that just was something I wanted to do. I just thought it was badass that you could make money by counting cards and things like that. That's probably why, obviously, I kind of led to trading as well. But to go into your final topic before we end this episode is kind of what you were talking about with finding the arbs, yeah, the arbs, with what you were doing like yesterday, right?
Yeah. Yeah. Exactly. It's just going where others that are more capitalized and more informed than you can't go. And I really must stress uh, that because it's really the biggest opportunity for people that don't have a lot of capital at the start. You are not going to make you are not going to grow $1,000 account trading futures, diversified portfolio of futures contracts, right? You are not just going to do that. You need to find something where you can take risk. Obviously have a job and grow capital and stuff like that, but you need to find somewhere where the returns are higher, the risk is much higher as well, but it's much harder for big institutions and very good traders to go in and take your edge. And you have to dig. You have to dig into it. There's a lot to dig and new projects and new stuff. A lot of risk to be taken. A lot of projects that need your liquidity, and if you can provide it at a reasonable expected rate, you will do fine, much better than other places.
This is interesting. I do agree with you. I think it depends on the trader to some extent because at least in my brain, I actually wrote a thread about this recently. It was like if I had to become profitable in 90 days, but it was realistic, like what would I do? And I went down the route of like, having a portfolio of systematic strategies and like being able to build capital alongside that, right? And add capital to it. So you're building like a really strong foundation where you're aiming for solid returns. They're not anything like high risk returns, but you're also not risking your full account, right? So I think if you're starting out and you know you're going to be able to add capital over time, then I think, at least in my opinion, you can do a sort of like, portfolio of systematic strategies, and then you build a really solid foundation from it. Obviously, you start it with small capital, so you make all the mistakes using very small capital. And then over time, you can add capital to it, whether that be through external sources, right? Or, as you're saying, you could go down the route if you want to take really high risk bets and see if you can, 10x your account or whatever, then that's going to be, as kind of Pedman said, going to other places where people aren't really. But you will need to know that when you scale that up, you need to switch to the other skill set I just described. Actually, do you think you could always compound your account by going to places others can't, or do you think you would eventually switch?
No, but if you can, no, I don't think, because it's people are willing to go there for a reason, and it's because usually it's low capacity. And
True.
but if you get the skills to make money in those markets, in those really hard markets to trade in, and low competition markets, you'll gain the skills to trade anywhere, basically. That's my opinion. Yeah.
Are you on Instagram at all?
No.
Okay, because like I just saw it recently around trading, and I thought it was hilarious. Like the fundamental message is true, and it's kind of what we're talking about right now. But it was an advertisement for prop firms, like futures and forex prop firms. So they'll give you capital, but you pay like a monthly fee or whatever, right? And
Yeah.
they were saying the amount of money you want to make is just because you need more capital. It's not because you need more percentage of returns, which is fundamentally true. Like if you had a 5 million account and you wanted to make 100K, that is by far a lot easier to do, right? Than trying to start with a $1,000 account. So that's how they were trying to advertise people to use the prop firms. But fundamentally, it's sort of what we're talking about here. Like if you have so much more capital, you don't need to go after these opportunities. You can do a lot like easier opportunities and make still a really solid amount of money. Whereas if you don't, then you'll have to go sort of for these.
Because then your objective is already protecting capital. If you have like $1 million, you don't want to go in places where you can lose those $1 million, right? You want to protect it, or it depends on the person, but yeah. We've seen people like take during really hot markets like 7 figures into 8 figures and even beyond. So it depends on the person.
Yeah, very true. All right, I think we'll end that here.